Okay, we are live. Welcome to Boston Basic Income, our weekly basic income discussion group. I'm Alex Howlett. The quality of the stream tonight might be a little lower than what we're used to, as it has been recently, because my regular computer is being repaired again. But we're going to do the best we can, and if the stream quality turns out not great, we'll upload a video of it later. So this week, we are talking about the shadow banking system. So for those of you who are not familiar with the shadow banking system, basically the simplest way to describe it is that there's a lot of unregulated lending and borrowing going on in the economy. And there's all kinds of arguments about why this is happening and whether it's to what extent it's a good thing or a bad thing, and to what extent that that this led to the financial collapse of 2008, and to what extent we can have dangerous credit bubbles in the future because these shadow banks are not regulated and therefore also not protected against collapse. So obviously this is a basic income discussion group. So I want to start by going around the room and asking a question. How do you individually feel, and you don't have to answer the question, but how do you individually feel about the banking system and what we can do to kind of keep it in check and keep it functioning and stable without having something like 2008 happen again? And to what extent does basic income factor in?
Good question. I actually don't feel like I really know yet. Like, one of the questions that came up that the article was also raising is how much credit is the right of, like, the optimal amount, how much risk is the optimal amount, because there's costs and benefits, right? You might be funding things that are useful, but you're also taking on risk. And so I guess I would have to learn more to kind of know what level we would want to target in terms of the banking system. And for example, if you regulate some things and then other people sort of find workarounds, is that because there's really a need there, or is that because there's sort of a problem there? That's something that I'd like to explore.
So you're saying,
today.
Is there a need for people to find those workarounds because there's something that's needed that's missing in the economy if they don't find them? That's
right, yeah, that kind of thing. So it's a little bit hard for me to say like what I think about the banking system before I understand it better.
Okay.
The only connection to basic income that I have is the one that you have, so I'll maybe let you say that one later on.
Okay, I will. All right, Roma.
My view on ways to make sure that the banking system doesn't pose an excessive risk to the global financial system is wholly informed by the class, by Perry, Mehrling, and the Coursera course. And essentially, from my understanding, the system, the shadow banking system, has to be regulated in such a way so that the banks realize that it's on them to manage their risks, and that the central bank, whether it's the Fed or the ECB or whoever, doesn't have to step in. But of course, the problem is that a lot of these transactions happen offshore, which is partly why this whole mess occurred, is because the Fed wasn't really able to regulate this because they don't have any jurisdiction per se on transactions offshore. So I think that realistically, this is why this is actually difficult, because central banks inherently, although they can make agreements with each other, as they did during the crisis, they only have really jurisdiction in their own land. So whatever way they can force these organizations to manage their risks globally would help. I am ignorant about basic income's role in this. I haven't thought enough about it, so curious to hear people's thoughts.
Okay.
Cool.
Steve?
Well, shadow banking is unregulated, but it's probably too big to fail, and everybody knows it's too big to fail, so they can just gamble like they always did. But I think it's hard to, or it was 2008 was just about impossible to get a mortgage, but keep your own mortgage out of the shadow banking system. You just lost control of it. So it's sort of hard to not use the banking system that then uses the shadow banking system.
Yep. Richard?
Well, it's just impossible to avoid these crashes. They're going to happen. You're just going to have to. It's just not a matter of if, but a matter of when. Like, it's about every decade or around 7 years or a decade that these crashes happen. You just have to try to pull release the steam out of them before they crash. But they're, like they were mentioning in the article, that the politicians are bribed by these through like black money and things like that, and so they're just not going to do anything. And the regulators are appointed by the politicians, so they're not going to be actually do anything. And they're looking for the sinecures after which are like these. They're going to go easy on it because they were looking for the easy money after they leave the regulation posts.
Okay.
I'm here to learn.
Here to learn. Yeah, so I mean, like, a lot of the questions that come up surrounding shadow banking are how to regulate it, and then how to protect it from a collapse, or how to
examples of shadow banking.
You should draw the balance.
I could draw the balance sheets. Let me actually draw the balance sheets. I have them right here. So this is a couple of us have mentioned the Money and Banking course by Mehrling on Coursera.
Yep.
Roma and I have gone all the way through it, and Bethany has gone part of the way through it.
I didn't get to shadow banking.
Well, he talks about it a little bit early on too. So this is his book, The New Lombard Street, where he talks about it. And if you really want to get kind of like a really insightful look into shadow banking, I highly recommend this book.
What is it called?
It's called The New Lombard Street.
What does that mean?
So Lombard Street is where the Bank of England is in England, and there was a guy named Walter Bagehot who in the 19th century wrote a book explaining how the Bank of England works. And the Bank of England was like the biggest central bank in the world back then. Now it's the Fed. So Mehrling is kind of doing a play on that, saying like this is probably what Bagehot would have written if you were writing now.
And Lombard Street was a bestseller apparently. Everybody wanted to know about how the banking system worked.
Yeah, right. So first we're going to talk about a traditional bank. This is what you normally think of when you have a bank. So you've got are you guys all familiar with I've gone over these before, the T-charts with the assets and the liabilities?
Mm-hmm.
So you've got, in a traditional bank, you've got, on the assets, you've got cash reserves. I think I'm going to find another marker.
There's a red one over there, and there's a green one in the middle.
Cash reserves, and you've got loans. Oh, much better.
Oh yeah.
So you're probably not going to be able to see this on the stream, but on the assets we've got cash reserves and loans. So cash is just like cash that the bank has in its vault, or maybe it's deposits at the Fed. So if they need cash, they can get it from the Fed as needed. And then loans are also an asset to the bank because so you borrowed from them, so they know that you owe them money, so that's an asset, right? And then for liabilities, they've got deposits, and they've got just extra. This is actually not liabilities, but their liabilities might be less than their assets, so you normally write that on this side here. So this is kind of like net worth, and it's good to have that kind of buffer there. You might call it like a capital buffer or something like that. So that's just kind of like extra money that they have.
Is that a liability? I'm confused.
It's not a liability.
They just write it on that side.
They just write it on that side so that both sides add up to the same amount. So you basically got cash reserves and loans are the assets, and then deposits are the liabilities, and then the difference is the net worth capital buffer.
And so if it's positive, you have some extra cash and plus loans or something is a little bit.
Right. So if you just imagine that we have all these assets, now some of those assets now you have some liabilities, but some of those assets correspond to something you don't owe to anyone else. So this is the stuff you don't owe to anyone else, right? But it goes on that side, just to balance it out. You can ignore it if you want.
Yeah.
It's not super important. So basically the way this works, so imagine you buy a house, you get a mortgage, which is a loan. At the time when you get that loan, you also get a deposit account. So you owe the bank money through the loan, and then the bank owes you money through the deposits, and then over time you pay back the loan. So that's kind of like the traditional way we think about doing things. But really most of the lending in our economy is not done this way. And I've mentioned this before, like when we were talking about Fed accounts, if everyone had a personal checking account at the Fed, this part actually goes away entirely. But the shadow banking system is still there. So this is regulated. Banks are only allowed to give out so many loans relative to their level of cash reserves and how much capital they have and that kind of stuff. Otherwise it gets too risky and you're not allowed to do it anymore. Yeah, go ahead.
Is there any regulation on the risk level of the loans, like the credit that the people have to have or anything like that?
Yeah, I mean, I think there is, but
Yeah, I think the Fed checks stuff like that, but that's a detailed question.
it is a detail, and something that's interesting is that if you get to a point where the banks don't need to hold on to the loans anymore and they can sell them to someone else, they don't have to worry about that risk anymore. So that's where the shadow banking system comes in. So here's a shadow bank. I'm just going to say SB. So you've got securitized loans. Securitized loans. I guess that should all be on one line, but that's one thing. So securitized loans is, say the bank sells the mortgage to someone. Now that other institution is maybe going to
Group them together.
It's gonna take your loan and it's gonna take other people's loans and it's gonna say, okay, here's a new instrument that represents, a percentage of everybody's
Like the
different
Big
loans.
Short, that's what they did. The
Yeah.
bundling.
This is exactly right, because the Big Short was
Okay.
about kind of the collapse of the shadow
Yeah,
banking system.
Oh, okay.
Yeah.
It's also a lot like if you invest with an index fund or something like that, right? Isn't it kind of a similar concept, like a mutual fund or an index fund, where you're taking the risk and you're kind of spreading it out by, instead of having like all your money in one stock, you have it sort of distributed across.
In that sense, in the sense that they're mixing it up with different loans, it is a little bit like that. But an index fund is not like a shadow bank. It's not. I guess the analogy kind of holds in that particular respect.
It holds in terms of one of the attractive aspects of it, which is that you're distributing your risk across a lot of different loans instead of into one loan, right? Or am I misunderstanding that?
Yeah, you're distributing the risk across a lot of different loans, and then you're also a lot of times you divide them up so that the ones that are the parts of it that are more likely to default pay a higher interest rate or something like that. So you get like the really, they call it like dividing it into tranches, and there's that whole aspect which we can get into if we want, but we don't necessarily need to understand this. Yeah.
Securitized? Why is it
Securitized just means chopped up into pieces, and now you have this instrument, a security. It's called, so when you're trading bonds and stuff like that, they just call them securities. That's just the word for it.
Okay.
So securitize is to turn it into that kind of instrument, turn it into a debt instrument. Yeah. And then this is credit default swap. That actually doesn't appear on their balance sheet directly, but basically what this is an insurance for if these things go bad, then someone will pay you, so you're okay. So someone has to be on the other side of that, providing the insurance and taking the deal.
I'm so confused.
A credit default swap.
What are these?
So
Credit default what?
Default swap.
Swap.
Yeah. So basically, what you're doing is you're saying I've got these loans, these securitized loans, right? And then if someone defaults, that means they can't pay the loan anymore, or if that is no longer valid. So what you're doing is you're saying, hey, I want to pay someone for insurance so that if someone ends up defaulting on me, they take the risk. So I'm paying you to take the risk. So you're basically swapping the risk with that person.
So it's just an insurance policy.
So you're
Yeah.
paying them
Yeah,
something.
but I
and
mean,
then-
that's like the Fed backing up the regular banks, insuring their money.
It's a lot like that, except this is happening all in the private markets.
Right.
So you're not getting it from the Fed, you're getting it from someone else.
Right, but it's the same model.
It's similar. You have this kind of backstop that
Right.
protects you, that insures you.
Yeah.
But then what happens if that backstop fails,
Right.
So the person on the other side of this, the counterparty to this, that's AIG, and AIG failed.
Well, there's also another difference, is that you have to pay for this, and with the Fed, you don't have to.
Right, that
That's
was gonna
true.
say,
Right.
like, you're
Yeah,
paying.
They
that's a good
pay
point.
for it,
Mhm.
right.
Right.
Yeah.
The Fed just provides an automatic backstop.
Well,
But in
somebody
some-
has to pay for that. Who is in that group of CDS?
No, so the shadow bank pays for that insurance policy.
Right.
It's
So
an insurance policy.
right. So AIG might be the one providing the insurance, for
Yeah.
example. So the shadow bank pays AIG, and now the shadow bank can be confident that even if this loan fails, they'll be okay.
Right.
But the problem is that if everybody is doing that, and then AIG is insuring everybody, now AIG fails. So you can imagine, like with a typical insurance company, let's say you've got fire insurance or something like that. Actually, we saw this happen recently in California. With the wildfires in California, it put, I think, the electric company out of business, or it put someone out of business
The
because,
electric company.
yeah. So, if everyone's house burns
They
down,
were
now you don't
Wait,
have
why
enough.
did the electric company work?
But the electric company had what was it? Were negligent in their responsibilities with their lines and things, and so that caused the fire, and then they were liable for all the damages
yeah,
and
yeah,
things. I think it was.
Right.
Right. So if you're an insurance company and you're covering, I guess that wasn't the best example because they're not an insurance company. But if you're an insurance company and you're insuring everybody's houses, if one person's house burns down, then you're okay.
Right.
But if everybody's house burns down, now you're out of business too, and you can't back up that insurance. So in this case, AIG was that
Yeah.
insurer.
So with the
Yeah.
fire example, they're
Yeah.
presumably assuming that it's like unlikely enough that would happen, that they're not really preparing for it in terms of how much
Yes.
they insure. And that must have been also happening.
They wouldn't have done it if they thought this was going to happen. Yeah.
Right. So there's some problem going in terms of the prediction model of the insurance company, right?
They were just pretty careless.
Yeah.
I mean, it's hard to say. There are various incentives there. In some sense, it's a little bit like a game of hot potato, and as long as you're not the one holding the bag in the end, you're okay. Maybe there's a little bit of moral hazard because if the whole system fails, then maybe the government's going to bail you out, that kind of thing. And that kind of did happen with the
That
AIG.
did happen.
The,
right.
the way that I've read the explanation is that they always thought that they thought that a nationwide housing slump had not happened since the Great Depression, so the likelihood that all of the securitized mortgages all falling in value was so low that it was not worth thinking about.
Right.
Yeah, and I'm sure that's right, but it's also true that even people's genuine beliefs are influenced by incentives. So they had no incentive to believe otherwise, right?
Absolutely.
Or they had no incentive to worry about it too much because that was such a scenario that was outside of the realm of reality that things would have to, if that was, it's like an asteroid hitting the Earth,
Right.
There'd have to be some kind of response from the government or contingencies or something like that.
Yeah, they must
Yeah.
have. Those insurance companies have predictive.
Even the actuarial
Yeah.
charts.
Actuary
Yeah.
charts. Yeah. What's going to happen? How likely is it going to happen?
Yeah, all the
Stuff.
financial
Yeah.
people, they do these things, but you can't predict the future, right? And then there's also, the system is so complex, each person acting within it maybe has a really good understanding of their one part of the system, but you can't simulate the whole thing necessarily.
A system can also, you could also just get unlucky in the sense that you take on a risk that is reasonable in expectation and then you hit the really unlucky event,
Right.
like everybody's house burning down at once. Or I'm not sure that's really what happened here, but that's another possibility.
Yeah. I mean, I think what happened here was pretty inevitable. And it's unclear that it wouldn't have been inevitable even with more better regulation or something like that. Asset-backed commercial paper, and then repo. So what's interesting here is that you kind of have a parallel thing going on here. So here in the regular bank, you've got the deposits, which are funding the loans, right? And here you've got, instead of deposits, you've got debt that you're issuing to like money market mutual funds and things like that.
What's the CP stand for?
That's commercial paper. So the idea here is that the commercial paper, so you have these securitized loans, residential mortgage-backed securities, and stuff like that. And then you issue this debt, commercial paper, and then you're using those loans as collateral. You're using these securities as collateral. What that means is just that if you can't pay this, then they get some of the securities. So people will borrow from you if they think that this collateral is good. Here, what happened in the 2008 crisis is that people stopped trusting this collateral. So then the shadow banks could no longer borrow using asset-backed commercial paper anymore.
Yeah,
Wait,
why
so
did they
this-
stop trusting?
This side is, oh, sorry, go ahead.
Yeah. So why did they stop trusting? Because they stopped. There was just a slight worry that some of the mortgages might default or anything, even though all of this stuff was really good. And most of the mortgages that were actually in the securities on the balance sheets of shadow banks never defaulted and never came even close to defaulting. Yeah, it was all the riskier subprime stuff that actually defaulted, and that did not touch any of these guys. But people just kind of were a little bit worried. So you just a little bit worried, and people can't borrow anymore, and the whole system collapses, right? So it actually, like if all you're looking at is whether these mortgages were good the whole way through. Yeah.
Interesting.
Yeah.
I want to understand a little more what these things are. Money market funding, that's like a money market account that anybody can have, like a savings account?
Like a money market
Okay.
mutual fund. Yeah. So
Yeah.
instead of having a bank account, you might get a money market mutual fund account, which pays a little bit higher interest.
Yeah.
And then on the other side of that, the money market mutual fund takes your money and then buys these things here from the shadow banks.
Yeah, so there's actually, I don't know how he has it in there, but he also draws a third entity, which would be the money market mutual fund.
Yeah, that's not on this page, but we,
Oh,
we
wait.
could draw them if we
So
wanted
the
to.
mutual fund, so my money is not going directly to the shadow bank, they're not the mutual
Your money
fund.
is going to the mutual fund,
Then they
They
are
issue
going-
you shares.
right,
Then-
which are like deposits.
Yeah.
Yeah, and
Yeah.
then they go and they buy asset-backed commercial paper and repo, which pay even more interest than they're paying to me, presumably.
Yeah, so the money market mutual fund, we can draw them if we want. They're right here.
But they're at regular banks too, money market accounts.
Yeah, it's interesting. So a lot of these institutions are both banks and shadow banks, right? So we kind of divide it up based on kind of what they're doing, but there's a lot of them were doing both. And then a lot of the kind of shadow bank institutions were affiliated with banks too. So when they started to fail, the regular banks came in and kind of bailed out the shadow banking system. But then that made it so the regular banking system was in trouble. So then the Fed had to bail out the regular banking system. So there was this kind of like
Cascade.
there was this cascade, and the way Mehrling puts it is that the shadow banking system collapsed onto the regular banking system, and now the Fed can step in and act as a backstop because they care about the regular banks, but they don't care about the shadow banks, right? But it's interesting because in the end, this stuff that was happening over here is what created all the problems, and the Fed ended up having to deal with it anyway. So part of the point that Mehrling is trying to make is that, hey, wait a minute, maybe we should be directly backstopping the shadow banking system, so then the crisis doesn't get so bad, because you're gonna have to clean it up anyway.
What do you mean by had to deal with it anyway or clean it up anyway? What did they have to do?
So
Regular bank.
the shadow banking system collapsed onto the regular banking system, right? So
the
now
Fed-
the regular banks were in trouble.
I see.
The Fed doesn't want the regular banks to
Right.
fail, so it
So-
bails out the
right.
regular banks, but a lot of bad stuff has already
Okay.
happened in the
Okay,
meantime.
so why have that extra
Right.
banking? Yeah.
So the money market mutual fund has, the asset backed commercial paper. It's an A, and they have the repo, and then over here they have shares, which are basically just like deposits. And Mehrling puts deposits in quote here because they're technically not deposits, but they're basically deposits. So now this is what you would use as your bank if you want a little bit higher interest rate, and then this stuff gets bought from the shadow bank, and then the shadow bank is holding the actual mortgages.
Is there one more balance sheet that consists of no words whatsoever, only abbreviations?
Oh, yeah, we're getting pretty close, aren't we?
Yeah.
Yeah.
Well, repo is not technically an abbreviation.
Yeah, actually, he writes RP in the book. Yeah, I mean, it's still short for repurchase agreement, but yeah. So when we were talking about Fed accounts, we were talking about eliminating this entirely, because if you have your normal bank account at the Fed, there's no role for this anymore. Your deposits are all at the Fed.
Right.
So the shadow banking system might be there, and through these types of things, money market mutual funds, etc., they're offering to pay a higher interest. So they have to lure your money away from, instead of luring it away from the banks, they have to lure it away from the Fed or the public bank.
Right. But the Fed wasn't going to be doing loans, so we were also talking about who would do like the mortgages and stuff.
Right. So there would be. I mean, you guys saw I don't know if you guys saw the image on this meetup with the giant diagram of all the different entities. It had like over 100 different, interconnecting, interrelated things. So there's still going to be people who are providing mortgages, and there are going to be institutions that do that. And I think there are some already that aren't. I think there are already some that aren't direct banks. So it's not just banks create the mortgages and then sell it. Like there are other institutions kind of creating mortgages and that kind of thing. So that would be fine. So yeah, just
That's cool.
kind of referring back to that discussion. So yeah, those are the balance sheets, and we can keep those up there for the rest of the discussion in case we need to point to them. Yeah, what's up?
One of the things I thought was interesting that had to do with kind of why it might matter who's doing what was the idea that when banks became bigger, sort of conglomerated into like a few larger banks, they started to offer less tailored loans. Which, because in some ways is more efficient. So, like, instead of knowing a lot about a specific business and then like tailoring the interest rate to that, I'm
they just have a standard.
They just have a standard one. But then that created like a need, like I was talking about, because then there were people who didn't apply, like qualify for that sort of standard one that wanted like a riskier, higher interest loan or whatever, and so that other people started stepping in and doing that. But that was kind of a strange. Is that accurate? That seemed to be what the article was talking about.
I think that is accurate. I also think that part of what happened is that the shadow banks really liked doing the business that they were doing. They needed more and more of these securitized loans in order to keep doing it. That meant they were pushing for more and more mortgages. Give us more mortgages so we can securitize them and make money and stuff. So then there was this kind of like huge incentive for banks to kind of generate mortgages or find ways to give people mortgages and that kind of thing.
And just to be clear, from my understanding, the money markets, so the bulk of this is not what we think of as like you and I. It's like institutional, like Harvard University investing their billions of dollars. And the reason why this happened is because it's beneficial for all sides. And so when it works well, everybody can take a cut. And when it works, everything is great. And that's why this thing exists and why it's humongous.
Yeah. And another, so there's that part, and then another question is, why are the conditions such that it is so beneficial to do this much lending? And that kind of comes back to monetary policy.
Yeah, I've got another question about, these are abstractions. So what embodies a money market? Where would I find that outside of a bank? What kind of organization would that be?
Vanguard.
Like Vanguard, any kind of investment bank. Like an investment, like when I say bank here, this is commercial bank. Shadow banks are like investment banks and stuff like that, and sometimes there's some overlap.
Okay,
but an investment bank
is mortgage companies.
Yeah.
So wait, sorry. Go ahead.
So and there are other kinds of organizations that deal with money and lending and stuff. I'm just wondering what they are, what some of them are, other than mortgage companies.
Well, the mortgage company will originate your mortgage, but then it'll sell it off to some entity that will package all of these thousands of mortgages and then create the securities out of them.
So there's all kinds of different types of entities, and even that there's more than I can really describe to you. I can give you examples and abstractions and stuff like that, but there's anytime there's a way to profit by doing some financial something, some institution will figure out how to do it, and then someone will figure out how to regulate that, and there'll be different categories and things like that.
Right, but are they known as financial institutions
Yes.
only,
Or only?
yeah, or can they be part of some other organization like an insurance company? I mean, is this all separate?
AIG was an insurance corporation, right?
Right.
It's hard to draw a line between, I think most people would say that insurance corporations are financial institutions of a
right.
kind, yeah.
Which is why they issue annuities and stuff, other than insurance, they do other
Yep.
stuff, yeah.
Yeah, and it's kind of like, you remember the savings and loans in the banks, like what's the difference, right?
Right.
And there was initially a difference because the savings and loans were trying to get around some regulations that applied to banks, but then
Right,
they eventually
right.
kind of became the same thing.
Yeah.
Yeah.
Oh, sorry, it was a simple question. So like Goldman Sachs is an example of a shadow bank? Investment banks
Yeah.
like that are also shadow
Yep.
banks?
Goldman
Okay.
Sachs.
Yeah.
Right.
Also an insurance company though.
Are they an insurance
Isn't it?
company?
Goldman
I
Sachs?
think of them as an
No, they're
investment
an
bank.
investment bank.
Yeah.
They're an investment bank,
Oh,
yeah.
they're regular investment.
And I
Yeah.
forget the other.
Yeah,
big
there was
name
another
ones.
one.
What are the other big
failed.
names?
JP
Lehman
Morgan.
Brothers.
Oh,
JP
yeah.
Morgan.
Lehman
yeah.
Brothers was one that crashed.
Well,
during
JP
the-
Morgan
Yeah.
didn't fail.
No,
No,
JP
it
Morgan didn't fail. No.
there was another one that
Right.
Bear
failed.
Stearns.
Bear Stearns failed. Yeah, the big events that happened were Bear Stearns, Lehman Brothers, and AIG.
Oh, yeah, Lehman
Yeah.
Brothers.
Bear Stearns and Lehman Brothers were not bailed out.
Interesting.
AIG was,
Why?
because that was when. It's pretty arbitrary.
Yeah.
So that was when they
must-
got around to
Other
saying,
guys
"Hey, we need to
must have
start
been
bailing
upset about
people out."
that.
Yeah.
Poor
basically.
Lehman Brothers and the other guys must have been a little pissed.
I mean, I don't think anyone was happy with kind of what happened. I don't think the AIG people were entirely happy either. I mean, it's just a matter of like, you're doing emergency things to kind of save the system.
Yeah.
Yeah.
That's true.
So I wanted, did you have something else? So I wanted to get back to this issue of, you've got a situation where it's good for everyone. Everyone, as long as the system's working, everyone profits.
Right.
And part of the reason why everyone profits is because monetary policy says, hey, we need a certain amount of lending in the economy. So we make it profitable to have this volume of lending in the economy because we need to keep consumer spending levels up. We need to keep employment down. We need to keep the purchasing power of the currency stable, et cetera, et
You
cetera.
mean unemployment down?
We need to keep unemployment down. Yeah, I want to keep employment
Yeah,
down.
right.
Yeah. So it's hard to say if you've got the central bank, if you've got the Fed incentivizing a certain volume of lending in the economy, it's hard to say that any amount of regulation would really be able to prevent a credit bubble like this. Yeah.
I did think of another question. I
Yeah.
can hold it if you want to focus more on this specific thing.
Well, I just want to say this is where basic income comes in.
Right.
Because if you have a basic income that is funded directly by the government, then that reduces the amount of lending necessary in the private financial sector to keep the markets going. So it allows the Fed to raise interest rates, and it prevents the credit bubble from forming in the first place. And that's regardless of what the regulations are, what the structures are, who's backstopping who, that kind of thing. It keeps everything smaller.
Well,
Yeah.
that's based on the assumption that people will stop trying to get loans if they. I mean, it depends.
Well, the
on
Fed raises interest rates, so they just make it harder to get loans.
Right.
But how is that directly tied to UV?
Yeah.
The
So,
interest rate raising?
You have to think about why the Fed keeps interest rates low in the first place, and it has to do with keeping people employed, making sure the economy is near full employment. And it has to do with keeping the purchasing power of the currency up. They don't want deflation, right? If you've got a basic income that's funding consumer spending directly, now the Fed doesn't need to keep interest rates low in order to stimulate consumer spending that's funded by the private financial sector, either directly or indirectly. Like it might be businesses that are able to borrow and then create jobs. So then that income for those consumers is indirectly created through monetary policy. But it's all lending in the private financial sector, which is inherently unstable. Whereas if you just have the government spending money into the economy and issuing it directly to consumers, that is not an unstable source of funding, and it doesn't have the fragility and the instability that you would get in the private financial sector.
I would think that they would still be quite wary of. Definitely, they would be wary of raising interest rates Well, no.
The
Yeah.
Fed will do what
Well,
it
no,
has
yeah,
to
if
do.
they pump money, maybe
Yeah.
they would raise.
If there's a huge fiscal
Yeah.
stimulus, which is what basic income is, then the Fed will respond appropriately. They don't want inflation. They're not
Yeah.
going to allow that.
So, can
Yeah.
you walk me through, because I'm thinking that Fed isn't going to raise interest rates to 7% or 13% or whatever. So whatever the returns are like through this system.
They will if they have to keep prices stable. Yeah. 13% is something we had in the 80s, right? We would have been higher than that. Yeah.
So I guess I'm thinking, how does this affect, like, your investors, like Harvard's endowment? Like, are they investing with the Fed, or are they just not getting those kinds of returns?
They might be getting screwed a little bit by this. Yeah.
Because the banks are investing with the Fed, and then Harvard can't invest with them.
Well, if you start, so the first thing that happens, if you imagine adding a basic income and then raising interest rates, is that the existing loans that are out there, the existing lending through the shadow banks and the private financial sector, that starts to come under stress. So you might trigger something like 2008 again. But so it would be bad for anyone who's like kind of holding assets, any mutual fund, any kind of endowment or something like that. But it doesn't have the Main Street effect that 2008 would have, because everyone's got this basic income that they're getting.
But I'm trying to understand, like, why, like, how it trickles through. Like, if the Fed raises interest rates, then banks want to put their money there. So, how does that have these other effects?
Right. So banks will buy treasury securities instead of lending to private borrowers, and then the private borrowers who were previously borrowing in order to buy securities and stuff like that are no longer able to do it. So it kind of crashes the stock prices and the prices of those kinds of things. Private borrowing. There's less private borrowing available. Like, if you want to borrow, and the interest rates are higher, then they're lending to the Treasury through Treasury securities instead of lending to you. And if there's already debt that's outstanding, I guess the question is, I guess if that debt, some of that debt might not be able to be paid back, so that's part of the problem. So some of these assets that are already out there might need to be written down or written off, because a lot of times there's rolling over of borrowing that is what enables the repaying of existing debt. Yeah. So I would imagine something like that would happen. That's a good question. Yeah. But yeah, so it's interesting with the shadow banking stuff, because it emerges from a need to have a credit bubble. The economy, the Fed needs to incentivize a credit bubble in order to keep spending where it needs to keep spending. So then the result is that a credit bubble will emerge wherever it can emerge, and wherever you can get around regulations, that's where you'll get around them. You can't regulate this away. You just can't. And it's not just about not being able to regulate foreign countries. It's about there's a stronger force, which is monetary policy, which is pulling in the other direction.
Before this system, was the growth rate just so much lower? Because this came about only in the 70s, right?
I would say this particular form of it came about in the 70s, but even if you read like Perry Mehrling, he says that the crash of 1929 was a crash of their version of a shadow banking system. Yeah. So it's kind of, I think it's a consequence of just the way finance works, and maybe in the Great Depression you could say the government was fiscally constrained by the gold standard. And then these days you could say that the government was fiscally constrained by people worrying about the deficit too much. So then that ended up, instead of borrowing by the government and increasing government debt, you had an explosion of private debt to make up the difference that was incentivized by the Fed. Yeah.
So what kinds of regulations do you think would be optimal with a basic income?
Well, with a basic income, I think we could do a lot of deregulating. Especially if we have Fed accounts, we can get rid of the standard commercial banks. It can be all shadow banking. You don't need an FDIC anymore, because you know that if you're not putting your money in the in the safe, risk-free Fed account, then you're taking on a risk. And you can just, like, if the market economy is not depending on this thing in order to keep going, it's okay if there are failures there. And it doesn't have to be as big of a collapse because you're not letting it get as big in the first place. Because you're not like forced to, you're not beholden to, keeping the currency stable, so you have to incentivize lending or something like that. So it can be a lot more stable and a lot more sustainable. You don't have this increasing instability in the financial market because you can just kind of keep it at the same level instead of allowing a credit bubble to happen. Yeah.
You keep saying that about the credit bubble. Why is that a good thing? I mean, from the point of view of
why is
financial.
not allowing credit bubbles a good thing?
No, allowing a credit. Why does a credit bubble happen?
Oh, it's like a way of giving people money. So more credit is really more money in the economy. So Alex is saying if you really should have more money through like a basic income, instead you're getting more money in the economy.
So the credit bubble is bad, but it's all you've got if you don't have a basic income. If you want to keep consumer spending up, if you want to keep people in jobs.
Are you referring to the credit bubble that comes from people owing, a lot of people owing money?
Yeah. Because the way you get people spending more, if you're the Fed, is you get people to borrow more. You get businesses to borrow more.
Right.
Yeah.
But the spending isn't correlating with the credit.
Yeah, it is. So you increase the credit, you increase the amount of borrowing, that increases the flow of money in the economy because now everybody's borrowed and they're spending more. That's why you're doing it.
So what is a credit bubble then? I mean, it sounds like a bad thing, like housing bubble.
It is a bad thing. The housing bubble is an example of a credit bubble. And so the point the argument I'm trying to make here is that it's a result of us not having a basic income.
Yeah, I know that.
Because a credit bubble might be bad, but also deflation is bad, right? Also, if people's source of income is their jobs, then high unemployment is bad, right? So you have to fuel the credit bubble in order to keep people in their jobs, in order to keep consumer spending up, to keep the purchasing power of the currency stable.
The spending because they're getting loans, okay.
Yeah, and they're getting loans because they weren't spending enough. Because then the Fed wants them to get loans. Yeah. And it's not just people getting loans; it's businesses too. There are a lot of businesses, like we've talked about, zombie companies here. Yeah. Yep.
But then it has this fragile aspect where if I owe you something and then you owe your mom something, and then like I can't pay you, you can't pay your mom, and that gets like spread out, and then
and that's something that doesn't exist if the government is just paying it directly.
Right.
If the government's just issuing currency. Yeah. Okay.
Right.
Anyone have any more thoughts before we get into the article?
Oh yeah, quotes.
Holding on to the ones I have.
Do you want to share them at all?
No.
Are you holding on to the thought? Okay, I see what you mean.
Yeah.
You're not holding them back. You're just trying to hold on to them.
No, not holding back.
Yeah.
I'm holding on.
Yeah. So I really do, if anyone's really interested in understanding shadow banking deeply, I highly encourage you to take the Money in Banking course. I got these balance sheets from Perry Mehrling, and he's the one who teaches that course, and he talks all about shadow banking, and this is his book, The New Lombard Street, which we already talked about. So let's get into the article. So the article is entitled the Shadow Banks Are Back with Another Big Bad Credit Bubble. Okay, so I think this is just from the title of the article, this is kind of to be expected. We should expect this cycle to continue because you need credit bubbles like this in order to continue to fuel consumer spending. Right?
Yeah.
How you doing, Ruba? Yeah. Okay. I hope the stream is going okay. It is. That's good. So the first quote is this one. If regulators wait to act, they can say with certainty that a credit bubble is about to burst, but they've waited too long. If regulators wait to act until they can say with certainty that a credit bubble is about to burst, they've waited too long. So I think this is. So I think the guy who wrote this article, Steven Pearlstein, this is in the Washington Post. He is thinking about it as a regulatory problem. As we need to figure out a way to regulate these things ahead of time, prevent them from happening in the first place. And it's kind of my contention that there's no way to do that. that you got to have something like a basic income.
Well, I think he seems to see it as like, he's not thinking about basic income, and so he seems to be seeing it as like different trade-offs. Like if you have more permissive attitudes towards credit or regulation towards credit, then you do have, it seems to imply like more employment, more economic growth, but you risk further and further as it gets bigger and bigger, this like crash that hurts everybody.
Right.
And so he seems to have this attitude of you should try to balance those two factors in your regulation. And he thinks they're erring too far on the non-regulating side.
Yeah.
That was my sense of like.
I think you're right, and I think you can certainly adjust the balance there, but there's no balance that you can. And of course, we're always trying to balance between these two things, between overheating the economy and preventing it from going into a collapse. And it's this very delicate thing that gets more unstable the longer we go. And the question is, I don't think there's any way to kind of balance it in such a way that a collapse never happens. You might be able to have longer periods of time between collapses if you allow people to be poorer and that kind of thing. It's one of these puzzles that I think doesn't have a solution in kind of the way people talk about it. And you've got different experts who kind of like look at it from a different angle, and they prescribe different things. And it's really there's no kind of consensus in this, and I think that's because they're trying to solve a puzzle that can't be solved without something like a basic income.
Another theme in here is the like idea that there's sort of real economic growth, like tangible economic growth, that is behind some of the credit, and then kind of like fictitious credit that isn't really backed by anything tangible. And I feel like that also is a lay perception as well.
It is. I mean, like, obviously it's true that, a lot of the financial growth has no kind of actual stuff that's being produced for people corresponding to it. But there's no easy way to kind of like separate the wheat from the chaff. And if you try to do that, then you affect kind of the financial markets in general and the credit markets in general. It's not. And then there's also the issue of part of what the Fed is doing is they're just trying to get spending up to the right levels, and they're trying to get employment up to the right levels. Does it matter whether those jobs are bullshit jobs or not? No, they're just trying to get incomes to consumers and make sure that they're employed, right?
I don't even think bullshit jobs. I think he would even consider that tangible. Like he's talking about things like stock buybacks and stuff that aren't even turning into jobs.
Yeah, there's stock buybacks, and there's also financial investments that don't necessarily have like a real counterpart. Like it's not producing anything real for consumers, any actual product or something like that. Right. You have businesses or financial institutions investing in other financial institutions and derivatives and stuff like that. And it can all kind of just build on itself without having anything real come out of it. And in order for real stuff to come out of it, it's really about the consumer spending. So there's like, if you have expansionary monetary policy, that might stimulate a little bit of consumer spending and then stimulate a lot of this other crap that feeds the bubble, right?
But I guess it doesn't matter, the bubble doesn't matter to the consumer except insofar as it is connected to consumer spending, right?
The bubble matters to the consumer when the bubble collapses.
Yeah. But doesn't the collapse only affect you through the channels that it was affecting consumer spending in the first place?
Well, yeah. I mean, a lot of people might lose their jobs. A lot of the ways in which consumer spending was funded might go away. People go underwater on their mortgages. That kind of stuff.
Right. Yeah. But I'm saying like that's all the stuff that was affecting consumer spending in the first place too, right?
That's how you were stimulating it.
Yeah.
Yeah. I think that's right. With a basic income in place, if there's a credit collapse, it doesn't affect consumers as much because they have their basic income.
And I guess one more thing about consumers is that like. It is expected that the average consumer is supposed to be invested in like the stock market and so on as a way to like fund their retirement, and like that's a big chunk of consumers too.
I mean, fewer than 50% of people in the United States own stocks.
That's still a big percentage of people, though. It's not just like financial institutions that affect like 1% of people. It's...
Yes, no, that is correct. Yeah, and like there's always going to be a stock market. I think after you have a basic income. And maybe interest rates are higher and stuff like that, the way to make money is going to be to provide things for consumers. It's going to align the interests of the business with the interest of the consumer more, because the money is always, if there's basic income, the money is always coming from the consumers. So then you have an economy that's working more for the benefit of people, and the firms that are successful and that are profitable are going to be the ones that are benefiting ordinary consumers more.
Well,
so
at
those
first it
might be
wouldn't
the
all
stocks.
coming from the consumers.
What's that?
I said at first it wouldn't be coming all from the consumers. I mean, as it was phased in, it's only at most, I don't know, maybe $1,000 a month. There'd still be parallel.
Right. So depending on the level of the basic income, the effect is greater the greater the basic income. So when I talk about basic income, just kind of in the abstract, I imagine a full basic income that's calibrated to the productive capacity of the economy. Now, of course, not all spending is going to be spending that's directly from the basic income. Like there's still going to be people with jobs getting incomes that way. There's still going to be people investing, getting incomes that way. But it really shifts it.
Yeah.
It shifts it to be more towards the consumer. Yeah.
I guess it also ties consumers less to the to credit bubbles in the retirement point that I was making before. Like the larger the basic income, the more of your retirement income is coming from the basic income, and the less less dependent you are. And it's people's direct investments, but it's also like they talked about like pension plans and other whatever retirement plans are still left in the economy are often invested in these kinds of instruments too. So a lot of people's well-being is tied up in it that way.
Yep. Any comments before I move to another quote?
I'm excited for the next quote.
It's just the next paragraph.
Oh.
So that's particularly true when it comes to the opaque and unregulated shadow banking system on Wall Street that has now supplanted regular banks as the leading source of credit for businesses and consumers. This shadow system gets its money from big investors rather than depositors, and it revolves around hedge funds, investment banks, and private equity funds rather than banks. So it's interesting because the way this guy defines shadow banking is just any form of unregulated banking. Whereas when Perry Mehrling talked about shadow banking, he's more talking about this. He's more talking about kind of money market funding of kind of this capital market securitized assets, lending of that form of lending. He's talking about a more specific thing. And this hypothetically could be regulated. So according to Perry Mehrling's definition, it's possible to regulate the shadow banks. According to this guy's definition, the shadow banks are whatever's left unregulated, and will complain about whoever's not regulated at the moment.
Right.
Interesting. So, I mean, he's just saying that it's even harder to see what's going on with the credit bubble when the banks are unregulated. Yeah.
That reminds me of my question that I held off from before.
Yeah.
So if you're not thinking of it as whatever is not regulated, but you're thinking of it in this way, why is it that there are opportunities for profit that the shadow banks are taking advantage of that the original banks wouldn't just have already been doing?
Because the original banks aren't allowed to because they're regulated.
So then if you were to try to regulate these other things, wouldn't that just push it back one more? So like that opportunity would still be there for somebody else to pick up.
That's what I meant.
The shadows of the shadows?
Yeah, exactly. The shadows.
That's what I meant when I said that you can't really solve this problem through regulation. And of course, Roma's point is valid too. That you can't regulate what happens outside of the country.
Yeah. Right.
Now, certainly, as Roma also mentioned, when the crisis happened, the Fed actually put some agreements in place, or all the central banks kind of put agreements in place with each other, swap lines is what they called them, where they were able to put in protections and backstops to each other's markets. It was kind of like a global cooperation thing where all the central banks got together and said, okay, we're gonna stop this global crisis. We're gonna backstop.
Because they have an interconnected interest in this not happening. Actually.
Yeah. So I think one thing that Perry Mehrling was hoping might come out of this is that it might evolve into having a more centralized world central bank. That I don't think that's really emerged. You have kind of the IMF, you have the Bank of International Settlements, you have the World Bank, and these guys all try to help manage the global financial system, but it's still a hodgepodge. And I think the author of this article, what's his name? Something Pearlstein, Steven Pearlstein, I guess. He's definitely got an opinion that these guys are bad, and he definitely uses language in such a way to kind of like frame it as, you know, I mean, what does he say? The big bad shadow banks are returning for another.
He calls people out by name and tells you
at the end,
later.
yeah.
Although
like
he does bring up an interesting political conflict of interest.
Yeah.
That's sort of separate from the other points we're making, but it seems like, you know, the president looks better when the stock market and the economy is doing better. And so there seems to be this like thing happening with Trump where like they don't really want to curtail the growth of the stock market. Even though this may end up hurting Trump if it crashes on his watch, like there's sort of this potential conflict of interest that he suggests is happening in politics.
And I think that's right. And it's not just the stock market. It's also, you know, presidents usually want the Fed to keep interest rates low because then more people have jobs. You know, there's more spending, more income, that kind of thing. It's not just the stock market. It's kind of everything.
All the economic pressures, except inflation, which they also don't want. So there's a little bit of pressure on both sides.
They say they don't want inflation, but usually I mean, like if you look at the 1970s and Nixon, he said he didn't want inflation, but he pressured the Fed to keep interest rates low. And then he put in price controls like before the election so he would get reelected. So that it didn't look like there was inflation, but then that ended up causing more problems, that kind of thing.
Yeah, so there's some issues there too. Yeah. And I guess it's interesting that the Fed has generally done a pretty good job of keeping prices stable in spite of these conflicts of interest. But there's no guarantee of that, I suppose, with the politics being what they could be.
So this is a big thing that is really important to a lot of people, which is Fed independence.
Right. So
the Federal Reserve is an independent agency. It's, Trump isn't allowed to fire Jay Powell under normal circumstances, even though he keeps threatening to. Yeah.
I mean, publicly.
So, we could, it's possible to lose this institution. But for a long time, they've been doing the right thing. And this kind of isolation from Congress, they get to make their decisions independently. That has been very helpful, very integral to the Fed. But it's also caused a lot of people to have conspiracy theories about the Fed. Like, oh, the Fed isn't even part of the government. I mean, it is part of the government, but it's, it's just much like the Supreme Court.
I was just gonna say that.
Yeah. And that's the analogy that people use. Like, it's kind of an institution that is set apart politically, so it can make the right decisions.
Supposedly.
It's supposed to. But I mean, like, same problem with the Supreme Court, right? Like, we're worried about that sometimes. But let's go on another quote.
Just watching something about the whole system, the justice system, just how complicated it is and how I won't go into all of that. Making a murderer, it's really good.
So these shadow banks have made borrowed money cheaper and easier to get, but they have also made the financial system and the U.S. economy more susceptible to booms and busts. And with another giant credit bubble ready to burst, so this guy believes we're ready to burst, this one having to do with business borrowing, we're about to learn that painful lesson again. So I just want to comment, he says these shadow banks have made borrowed money cheaper and easier to get. I would say that the Fed has made borrowed money cheaper and easier to get. And then the mechanism through which that happens is the shadow banks. So if the shadow banks weren't there, that would mean maybe the Fed would have to do even more to get people to lend and borrow or something like that. I mean, this is all incentivized. This is all kind of endogenous to monetary policy.
I have to admit I didn't read it, but why does he think it's ready to burst? Does he give any evidence for that?
I think it's really hard to say.
But does he
when
have
something
any...
like this?
He has
does.
some. Yeah, he has some. Yeah. I forget what his metrics are. He has some different metrics.
He talks about the yield curve inverting, maybe.
He might.
Yeah. And I mean, there's always an argument to be made that it's ready to burst, and it might be. There's always someone saying it's about to burst, and then whoever happens to be saying it at the time when it does burst ends up feeling like a genius. But
I think there have been as many instances of the yield curve not leading to a shock in the next year as there have been when
it did.
Yeah. It's a really tricky thing to predict, and it also depends a lot on what the policy does, what we do with our economic policy. It depends on what the Fed does. Like, they could continue to fuel this thing for a long time if they wanted to. We've heard talk of recently, I guess as recently as yesterday or today, that Jay Powell is talking about lowering interest rates again. So that might keep it going more, right? I think the important thing to realize is that it's not a stable thing, and it could collapse kind of at any time. And you know, what's his name? Pearlstein argues that shadow banks are the problem, and that we need to clamp down on shadow banks. And I say that won't make a difference. I say lack of basic income is the problem, and we need to clamp down on lack of basic income.
Clamp that down.
Yeah.
Keep it under control.
And then, as Bethany says, the other shadows will take
exactly.
over.
Yeah, there's always going to be shadows, and you know, more broadly than basic income, it's a consequence of the Fed really trying to balance its budget or keep the deficit below a certain level, because if they're not spending enough, it forces the Fed's hand. The Fed doesn't have a choice. Like I keep saying, it's all because of monetary policy, it's all because of the Fed, but the Fed doesn't have a choice. They have to do this to keep the economy working the way it's supposed to work, to keep the currency working the way it's supposed to work. Yeah.
And we can't even not bail out the shadow banks, because the shadow banks collapse onto the regular banking system or onto businesses that we want to survive.
Right. And we're probably all better off if we do bail out the shadow banks, because then it doesn't have to get as far as it got in 2008. Yeah. Do you have any more comments? Moving through here. So this is he's talking about which this book was written after the 2008 crisis. So Mehrling doesn't get into this much. He still talks about mortgages and all of that. But this article was written last month. So after the crash in 2008, shadow bankers shifted their attention to business lending using the same securitization process to buy and package leveraged loans. Bank loans to big companies that were already highly indebted into collateralized loan obligations, or CLOs. Investors couldn't get enough of the CLOs, which promised higher returns than low-yielding government and corporate bonds, and corporations gorged on leveraged loans to fund mergers and acquisitions, buy back their own shares, and pay special dividends to investors.
So that's your thing right there, which is, it talks about the low yield government and
Yes.
corporate bonds, right?
I'm
that's
glad
the
you said that, because I was about to
alternative
say
that
that.
the government controls. That's the
Yes.
interest rates, right?
There wouldn't be low yield treasury securities incentivizing all this if the Fed allowed the yield on treasury securities to go up, right? Yeah.
That's how language is gorged.
Yeah,
It's
he's got an
also
opinion.
negative.
Yeah.
Yeah.
Yeah, and like you were saying, Roma, like you could write the same paragraph with language about how everybody is prospering and profiting, and you know, it wouldn't seem the same.
Right.
Like you could really flip it around how it seems.
Yeah.
Yeah, it's interesting.
Yeah. I hope we didn't lose Mitchell on here. He usually has more comments.
Yeah, he does. Maybe the stream quality is not so good.
Which tab are we?
Sue your computer
This
company
one.
for damages.
So meanwhile,
We lost Mitchell.
It's his work.
we lost Mitchell. Yeah, that's worth some money right there.
Exactly.
Yeah. Meanwhile, the Financial Stability Oversight Council, comprising all the government's financial regulators, has also been sitting on its hands, monitoring everything but doing nothing. The council was created by Congress as part of the Dodd-Frank Financial Reform Bill as a last line of defense against financial crises. But as with most other provisions of the law...
Oh, he's there. Yay.
Oh, great. Hey, Mitchell.
Adios.
But as with most other provisions of the law, the policy of the Trump administration has been to ignore or undermine it. The council is headed by Treasury Secretary Steve Mnuchin, a former Goldman Sachs investment banker who eventually made more than $10 million buying and selling with partners, a California bank that, after engaging in aggressive mortgage lending, failed during the last housing crisis. So I highlighted this because this is the calling out.
Yeah,
this is part of the calling out.
He does it later too, but
He lists a bunch of names. Yeah.
he's trying to make him look bad by talking about how he bought and sold this company that failed.
And I mean, like, is that a bad thing? It's a market and there's a price, and
It's
you want to.
complicated.
Yeah.
And who do you want on the Fed? I mean, it's hard to say, I guess.
Right.
If he was a Goldman Sachs banker, he probably knows some things, but also maybe they're arguing he has the wrong.
Well, he is the Treasury Secretary, so he's not part of the Fed.
Sorry.
But he is partly responsible for the Financial Stability Oversight Council. So,
right.
you know, I mean, I think we can find cracks in regulation and criticize regulation all day. Regulation is really inefficient and slow to respond and all of that. I don't think there's any degree to which you can fix it that will fix this problem. Yeah.
I think that there must be things we can do though, because I like your arguments, but let's just face it, it's not going to happen in the next 4 years, and we should be scared in the meantime.
You mean
Yeah.
basic income is.
Yeah.
I mean, let's just
Unless Andrew
call a
Yang
spade a
does
spade.
I think you're right, and I think it would be probably beneficial to do some of the stuff Perry Mehrling is talking about, more directly backstop the shadow banks. In terms of regulation, what can we do to regulate? Do we want to? I mean, I don't know. There's certainly have you guys heard of like Basel III and capital requirements for banks?
Yeah.
So that's kind of like an international thing, where they have these requirements for financial institutions that all the different countries kind of sign on to, and all the banks have to follow these requirements. So that can provide some resilience. I think it's possible to kind of use band-aids like this to kind of extend things further until you come up with a real solution. Basically, what we need to do is because we're not printing money and paying people a basic income, we need to figure out a way for the private financial sector to be able to print money, get it flowing in the economy, and minimize the fragility of it. So that might mean, instead of the government directly printing the money, that might mean the central banks, more actively backstopping the credit markets, more actively backstopping, like the dealer markets.
Don't the FDIC money market or whatever?
The FDIC
No.
does not cover money market mutual funds.
That's the whole point. You
Yeah.
could get a higher return
right.
without it failing.
Yeah.
It
There
has
are
essentially never, even during the crisis, only
Right.
one of them failed,
right.
and people were able to get something like 95 cents on the dollar,
I see.
something like that. I don't remember exactly,
Yeah.
which is nothing. Like, that's not a huge failure.
Right.
The first one.
Yeah.
The first ever one was the one that failed. And FDIC, I mean, that only protects kind of what we think of as like the traditional commercial bank deposits. It doesn't even protect the bank itself, it just protects people's deposits at the bank. And there's a lot of the economy which is not just people depending on having their deposits. It's, different financial institutions and firms needing to be able to borrow to stay in business, that kind of thing. So you might keep your bank deposits, but everybody loses their job. That's still going to be problematic.
I guess the FDIC thing helps prevent like a consumer run on the bank.
Yes.
So I wonder if there are other kinds of things that would increase the overall trust level. Because as you pointed out, like most of the mortgages were good, but there was still this trust problem.
And I think that's right, and that's what Perry Mehrling advocates. He advocates, having the central bank be a dealer of last resort. So right now they're a lender of last resort if banks need to borrow and they can't borrow from each other, that kind of thing. If they're a dealer of last resort, then what they're saying is we're putting a floor on the price of this security, and we'll buy it if it we'll buy it at this level. But just by making that promise, it probably won't even come down to that level.
Right.
But if they had done that here with these securitized loans, then maybe the shadow banks could have continued to borrow using their asset-backed commercial paper because they still had something that was good enough to use as collateral, that kind of thing.
Right. So this is kind of to your
It was
point.
really
Other things that could be done.
So I think you're right that there are things we can do, and this is one of them. And I think Perry Mehrling is on the right track with these things. But again, it's still. So I guess the trick is to, instead of directly, like I was saying before, instead of directly having the government print the money, you still have the government print the money, but it's hidden behind, oh, it's really the private banks doing it and the government's backstopping it, but it can never really fail. So really the government printed money, but we're just not saying it, right? So you could probably do that forever, actually. And we have been doing it for a long time. We add more regulations, we add more backstops, that kind of stuff. So we could continue that, but we still do have credit bubbles. Can we prevent them entirely forever without having a basic income? I think hypothetically you could.
Or just make them smaller.
Make them smaller, yeah, so they don't affect as many people. But you're really, you're doing this thing where you're pretending not to do what you're really doing, which is printing money and handing it to people.
You also run into distribution differences relative to a basic income.
Yeah, it's very hard to get banks to lend to people who don't have any way to pay back the money. Or I should put it another way. It's very hard to get banks to lend to people who don't have any money, and the banks don't think they have any prospects of paying it back or being profitable.
Or if they do, it's like a really difficult circumstances for those people.
Right, and they're technically not allowed to either. Like we were talking about before, there's regulations where banks have to make sure that loans are good and stuff like that. So if you really want to so you can't get the full effect of a basic income, you might be able to mitigate the credit bubbles, but it's probably going to be really hard to figure out a way to hand people money, no strings attached, in a way that looks like you're not doing that. Yeah. And maybe the labor market serves that role a little bit.
Right.
Getting jobs, and the jobs are funded by borrowing, and then people's wages are no strings attached. So maybe that's we've been doing that a little bit.
Yeah, and you're wasting people's time.
You're wasting people's time. Yeah, you're still not achieving the same effect as the basic income. Yeah.
Cool.
Yeah.
Next quote.
Next quote. Do we even have another one?
What? We got through all the quotes.
I think we got through all the quotes. We can look at the article.
I have a lot more questions from the article.
Yeah, go ahead.
Well, I don't remember. We'd have to start scrolling through and then.
Do you remember any of the words that were related to it?
I can start looking on my phone though.
Yeah.
Other people ask.
What was the Dodd-Frank amendment, do you know? I think Arne Frank was responsible.
Yeah, he was the Frank.
For that. Oh yeah.
Yeah.
So what was that?
So that was after the financial crisis.
Right.
They did a few things where they tried to put measures in place to prevent something like that from happening again. One of them was they made it so that banks were not allowed to invest their regular, like the money that needed to be there to back up consumer deposits and regular stuff, like the regular commercial banking stuff. They weren't allowed to invest that money into speculative markets anymore. I think that was something that had been mostly true before 1999 when they repealed something called Glass-Steagall. So Dodd-Frank brought that back a little bit. And then they also, I guess there's something called the Volcker Rule, named after Paul Volcker. And that's where, if the bank has this two different kinds of activities, they have to keep them separate. So then it's protected. If one part of the bank fails, then the other part won't fail, that kind of thing. There's been some, criticism of Dodd-Frank that it doesn't really address the shadow banking system. It's really focused on the commercial banking system again, and keeping the commercial banking system separate. So it doesn't necessarily address some of these problems with the shadow banking growing and then collapsing, and then maybe it prevents some of the shadow banking from collapsing onto the regular banking system, but it's still going to find a way, right? Because the economy is depending on all the shadow banking activity. So I don't know that it fully addresses the problem. But I'm not an expert on Dodd-Frank. But basically when you hear about it, people talk about it as measures that were put in place to prevent another 2008 from happening, and keep the bankers under control, that kind of thing.
That's what I heard.
Yeah.
The other criticism is that it's extremely big. It's something like 5,000 pages plus.
Oh, really?
Wow. So there's just all kinds of
all kinds of
rules
piecemeal measures
Yeah.
without addressing the actual
Right.
problem, underlying core problem.
Right. But there are certainly people who turn to it and say, hey, we need to be enforcing this, we need to be building on it, that kind of thing, because they see it as something that was put in place and that's protecting us or should be protecting us. Yeah.
So there's a paragraph that starts, if all this newly borrowed money were being used. And this one talks about, somebody asked about, like, does he have any evidence that, or what does he think is the evidence that it's going to burst soon? Oh, I think he gets into that in this paragraph.
If all this, oh, that's because the ad came in. If all this newly borrowed money were being used to create new technology or enhance productivity, piling up this debt might be a risk worth taking. But the evidence suggests that what it is mostly doing is artificially stimulating the economy. Companies have used much of this newly borrowed money to buy back their own shares, pay special dividends to private equity investors, and acquire other companies, all of which have had the effect of inflating stock prices. The recent wave of richly priced mergers and overpriced stock offerings and the declining returns offered by recent commercial real estate deals are all good indications of a credit bubble waiting to burst. Did you have a particular thought?
Well, he seems to think that he can separate, like you said, it's sort of hard to separate like productive investment from not so productive investment. He seems to think that he can kind of like separate the two, and I guess I wanted to know what you thought about that.
Yeah, I mean, I think he has a point that a lot of the money is going into inflating stock prices. That pretty much always happens, though, because anytime you're using monetary policy to create money, you can't really control the distribution of it. So some of it gets out to consumers, and some of it stock buyback. Some of it's,
What's a stock buyback? Is that you buy back your? Why would you want to buy back your own stock?
So you can increase the price of it.
It increases
fewer shares around.
Oh,
Right.
I see.
It increases the price of it, and because maybe you have nothing better to do with your money. So
and also because a lot of the CEO compensation is in stock shares. Then if you buy, there are fewer shares to go around. The amount that you have, if you're a CEO, is increased, so that you have an incentive to keep buying back stock. So that it looks like you're actually doing something, and so that you actually have the price of your stock goes up as well.
Yep. So I see. So that makes sense. Interesting.
But I think, and I think part of what he's doing here is he's saying that this is evidence that companies don't have anything useful to invest the money in.
Right.
So, and I think there is some of that too. Like, if you're the CEO of a company, maybe you have some incentive to make the stock price go up. But also, if your company fails, the stock price goes down. So, and if your company does something really amazing, the stock price goes up too. So the fact that you're just directly buying the stock to drive the stock price up suggests that there's nothing you can really do.
You're not like poised to open a new factory if you just get that money and then like you get it and you open a new factory. Right. Because if I want the stock price to go up and I can, improve the performance of my business, that'll do it too. Right.
But maybe there's no way to do that because you just have all this extra money and there's nothing, productive to do with it. So I think that is a legitimate point, for sure. Yeah.
Right. Declining returns offered by recent commercial real estate deals.
They mentioned in the article that you could just pay interest and not have to pay for the principal until the end of the loan or something.
For real estate deals?
That's what they mentioned in the article.
Yeah, he did say that was happening. You just pay the principal at the end.
Yeah, I don't know. I don't know why the declining returns offered by recent real estate deals would be.
Maybe it's the idea is again that you just like have all this money and there's not even anybody that really needs the real estate, so they're not willing to like do it unless it's a really, really good rate for them. Something like that.
I see. Yeah. Yeah, and that can be related to, so the interest rates on real estate deals are so low, right, that there's no one who really wants to use the real estate productively, so people are trying to get rid of it.
Yeah.
Yeah. That makes sense. And those interest rates are less affected by the Fed because the Fed controls more short-term interest rates. So this could be actually related to, what we think of as a yield curve inversion, where the longer-term interest rates come below the shorter-term interest rates. Because the Fed has control on the shorter term interest rates, but they don't have as much control on the longer term interest rates. So they can do everything they can to keep interest rates here, but then nobody wants to borrow in the longer term. But I think so when we talk about yield curve inversion, the main reason that people say it happens is because people are expecting interest rates to go down in the future. So they're buying longer term, they're lending longer term to lock in the interest rate now before it drops even further, instead of lending short term, which might even be a little bit higher interest rate, but then that's over, and then when they try to lend again, it would be a really low interest rate.
Right.
So that's, I think, the main reason we talk about inverting yield curves. And it has to do, obviously it has to do with expectations, and people's expectations can be wrong and all of that. It's weird because you see these things that are reflections of people's expectations, and then people use them as evidence that the thing is going to happen. So it's kind of this self-fulfilling or self-reinforcing feedback loop kind of thing. Yeah.
Interesting.
It's like, oh, the yield curve's inverting, let's all panic. Then the panic causes the yield curve to invert even more, and then maybe nothing happens. It depends, right? Yeah.
Alright, I'll try to find one of my other ones.
Yeah.
Oh yeah, the difference in interest rates between so a few paragraphs up. Meanwhile, the difference in interest rates between the safest loans on the riskiest, in financial jargon, the spread, is at historically low levels. A reliable indication of too much money chasing too few good lending opportunities.
Yeah, I think that's right. So the yield curve talks about time, and this is talking about risk. So you expect interest rates to be higher the riskier the investment.
Right.
But if you have money that you want to lend, and the only people who want to borrow are really risky, that lowers the interest rates even on risky stuff.
Interesting.
So again, that's an.
And there's kind of a floor set by the Fed, so that's why that would make the spread lower, as opposed to just shifting everything lower.
There is a floor set by the spread. There is a floor set by the Fed. You wouldn't want to lend to anyone at a rate that's lower than the rate you could lend to either the Fed through interest on reserves, or to the Treasury through Treasury securities. Yeah.
Although I think that was violated leading up to the crisis, because not everybody has access worldwide to the Feds.
So you're talking about the Fed funds rate falling below, or being well below LIBOR. You're talking about the spread between Fed funds and LIBOR. Yeah. So the Fed actually didn't start paying interest on reserves until after the crisis. But the rate at which banks borrow from each other, if you're a member of the Federal Reserve, is the Fed funds rate, and that is not everyone has access to that. So then if you're not an American bank, for example, if you're a European bank. So if you're a European bank and you wanted to borrow money, it got a lot harder to borrow money. So then the rate at which non-American banks were able to borrow ended up going a lot higher than the rate at which American banks were able to borrow. That was a sign of kind of stress in the system leading up to and during the crisis. Yeah. But yeah, I mean, it is also true that not everyone can lend to the Fed. Not everyone's a bank that can hold reserves at the Fed. So there are instances where the borrowing rate between banks ends up falling below the interest on reserves. So that happens too, but it happened kind of after the crisis. So we didn't have this until the crisis. And then that's kind of like the same kind of thing where some banks just don't have access to it. Yeah.
In the last sentence you highlighted there is the word systemic. I think is important for a lot of what we've been talking about.
Mm-hmm.
Systemic in the sense of global, or happens to the whole system all at once, as opposed to local or random.
Right.
So
or isolated.
Yeah.
We go back to insurance, but I'd say the car insurance is still random. There's bad car accidents, but they're random rather than all 1 year, they all happen, all in one place.
You could imagine an earthquake, right?
causing a lot of car.
Causing a lot of car accidents, yeah.
Okay.
And that's a systemic thing.
Yeah.
Yeah.
And the opposite might be like flood insurance, where it doesn't flood random people.
Right.
It'll be the whole place, or the earthquake. Or
Yeah.
didn't we mention? Oh, we were talking about an asteroid hits the Earth. Now, asteroid insurance is highly systemic,
Yeah.
and you'll make a lot of money, and you'll probably never have to pay any claim holders because the Earth is destroyed. So that's the business we should all go into.
Yeah.
So the question is, why didn't any economist see the systemic risks in shadow banking and the credit bubble? Because even I see some systemic risks in interest rates not for the subprime mortgage holders who had to refinance it every year, or otherwise they couldn't really afford it. Depended on some slight changes in interest rates, and when the interest rates didn't go the right way, it would impact all the subprime mortgage holders who all had to refinance it. So it seems like that was visible, predictable. It was a systemic risk that was almost inevitable.
Well, like I said before, I think there's always people who see these things and kind of put the evidence together in a compelling way, and then some of them end up being right and some of them end up being wrong, and it's hard to tell who's right. It's hard to know who to listen to until after the fact, and then sometimes they just get lucky. But I agree with you that there's stuff there that we can look at and analyze, and it seems pretty obvious. Hindsight is 20/20, right?
So I think that in this particular case, probably there were some really informed economists who were really worried about this. But one of the main things that caused this was that AIG held too many of these CDSs, and also not only that, the way that the clause was written is that and this is just kind of the one element of this perfect storm. The way that these contracts that AIG were written is that if their credit rating were to be downgraded, their own credit rating for any reason, then irrespective of anything, they would have to pay. They would have to pay the money, irrespective of what actually happened to the security. And so, probably, if I had to guess, nobody even, like, your common economist doesn't know. Nobody knew who had what.
Yeah.
Like, it's not public information. This is not stuff you see in the FT. Like, how many CDSs does AIG hold? It's only after the fact that, oh, by the way, they have the amount of the amount of insurance that they are liable for, like 80% of their whole net worth, something like that. Right. It's only after the fact, once things came crashing down.
Yeah, and all the books got opened up. Yeah. And I think another point is that, what was I going to say? Another point is that I think a lot of economists predicted the collapse of the subprime housing market. What they did not predict was the global financial crisis, the collapse. They thought, oh, well, subprime is risky, it's subprime, it might collapse. Yeah. And what ended up happening, like I was saying before, is that it wasn't that these mortgages were bad. These mortgages were good. It was just some people somewhere saw the subprime collapse. They got a little bit worried about these mortgages, maybe irrationally so, and then that irrationality caused them to not accept it as good collateral anymore. Then the shadow banks couldn't borrow, and the whole thing collapsed. So it wasn't really a housing market collapse that caused this thing necessarily. It was just a subprime thing that everyone, I think, quite reasonably assumed would be localized to the subprime.
Okay.
Yeah.
Perception is more important than fact.
Sometimes, yeah.
To be fair, the housing collapse wasn't pretty either.
That is also true. Yeah. But it's kind of there's that, and then there's like that. Yeah.
Right.
Yeah.
Mitchell's saying something.
So Mitchell says, a metric I saw is the number of insured institutions, FDIC insured institutions, has been declining while the U.S. population has grown.
Interesting.
And I think that's true. And I think a lot of what's happening here is just bank mergers, right? So it's not that people have less access to FDIC insured accounts. I think it's just that you have fewer smaller banks, more bigger banks, that kind of thing. And that might present, complexities of its own, but I don't think it's an indication that there's less insurance available to people or something like that. Yeah.
And just so everybody knows how this went down, what the banks did with the government's money after the fact, after the initial bailout, there continued to be bailouts. So instead of lending, they just started to buy each other up.
Merge.
Yeah. Yeah, so I think that's probably part of it. Yeah. Do we want to find something else?
Sure.
One more. One more.
I have a question about Mehrling really talks about the World Central Bank.
When he's kind of like fantasizing about the future and like what direction things are going, he talks about first he's a historian, right? So he looks at things in a historical perspective and like, oh, this is how central banking emerged, and then he's like, is this the emergence of a more coordinated central banking system for the global economy, that kind of thing, and he gets excited about the possibilities in the future.
But he's not a. Is he a modern monetary theory guy?
No.
Oh, okay.
Definitely not. He does like Hyman Minsky, though, who is cited a lot by MMT people.
Okay. Because part of MMT is that you want to, a nation wants to have its own currency and wants to have its debt in its own currency.
Right.
Okay. But with a world central bank, that would, America would lose out on all the tricks it can do now.
Yeah, it's probably, well, yeah, it's tricky too because the world monetary system is kind of hierarchical. Like the dollar is the world's reserve currency, and a lot of the other currencies and a lot of the other contracts are kind of either directly or indirectly in terms of dollars. So we do kind of have that hierarchy and that centrality already there to some extent. For MMT, I guess it's a matter of being able to issue your own currency and also have the fiscal authority and the monetary authority be at the same level.
Right.
So a lot of the MMT people complain rightly about the European Union, where each country has its own fiscal policy, but they all share the same monetary policy, and then they can't do the kind of stuff I talk about, like issuing a basic income, that kind of thing. And there's certainly tensions because different economies in the European Union need different monetary policies, but they all have one central bank.
Right.
So yeah, so there's certainly some challenges involved in bringing together the central banks. But the fact that they cooperated and coordinated with each other after the crisis, I think Mehrling was looking at that as an indication that we could be moving in that direction. But we can't just have. I think it's impossible to just have a world central bank without some other kind of central authority to go along with it on the fiscal dimension. Yeah.
Okay.
Yeah. Did you find another one, or?
I got distracted by you guys. But there's the paragraph that says, and even though traditional banks may be making fewer loans to mid-sized businesses, or I guess we could go even further above than that, but
Okay.
But no, we can do that one. They've been eagerly lending to the hedge funds, private equity firms, and business development companies that are making more of those loans. So I guess I'm just wondering, like, why would banks be getting more into this than they were before?
Yeah, that's a good question. It could be related to what you were talking about before, where it's simpler to kind of do a standard thing and then let someone else worry about the details, that kind of thing.
Oh, the mid-sized business loan, you mean?
Oh, I guess I was wondering why they're loaning more money to hedge funds and stuff.
My guess is that they don't want to lend to the mid-sized businesses directly, and they know the hedge funds are good for the money. It's probably coming more from the hedge funds. The hedge funds are saying, hey, we're willing to borrow and we're good for it.
Right.
And that's maybe a more reliable borrower than trying to lend to individual mid-sized businesses.
And hedge funds have just been growing and there's more of them, or they have more money, or...
Yeah, and the hedge funds are, focusing on making the individual loans, and then they just get funded from the banks.
But why is it more worthwhile for the hedge funds to make the individual loans than the banks?
Because hedge funds look at all the individual facts, where the banks don't have the time or the incentive to look at all the little facts of the businesses.
Hedge funds are also not regulated, so they're more interested in taking risks, that kind of thing. Banks probably have to go through a much more rigorous vetting process to do that lending. But if you're a bank and you're lending to a hedge fund, and the hedge fund is good for it, you can do the vetting process for the hedge fund as a whole and then lend to them.
Right.
So this is just kind of like what I'm constructing in my head to answer your question right now. It's like a hypothetical reason.
Interesting. And hedge funds are industry specific?
What do you mean by industry
or
specific?
Not necessarily.
What do you mean?
For individuals.
Like, I feel like Gabriel started a hedge fund for some particular kind of thing, like industry.
For a specific industry.
Yeah.
They can be. They can be all over the place. They can be all kinds of different things. It's just anyone who has a good pitch to institutional investors and says, I got this idea for how to make you a lot of money and what kinds of things we can invest in. It can have a theme, or it can be,
right,
just based on whatever. Yeah. I'm
just thinking of what you were saying, Richard, about how they might have more incentive or more interest in like finding out the details about these different opportunities.
Yeah, I think that's part of it, and I think also like what we were saying is that they don't have to go through as much of a vetting process.
Right.
They don't have as much red tape to kind of cut through. So the bank cuts through the jumps through the hoops once for the hedge fund, and the hedge fund is free to do what it wants.
Yeah, I see.
So it's kind of like, it's shadow banking, right?
Yeah.
Yeah.
Yeah, so they get around the regulations.
Yeah.
Right, so they're basically loaning to an entity that can do with their money what they might do if they weren't so regulated.
Yes.
So it's like you just have this way of getting around it.
Yes. And they're not going to make as much money as they would have made if they weren't regulated, but they might make more money than they would by putting all the resources into trying to do this manually.
Yeah. Exactly. Given that they are regulated.
Right. So right toward the end, let's go around and get final thoughts from people. Final thoughts about shadow banking, and we can bring it back to basic income if you want to. Any thoughts about today? Yeah.
I feel like I understand shadow banking a lot more than I did before, which is thanks to you, mostly.
Thanks to Perry Mehrling.
Yeah, thanks to Perry Mehrling and Roma and other people who chipped in.
Yeah.
I guess I also got a lot out of the conversation we were having about like how would you try to regulate it or manage it, like given that we don't have a basic income. Sort of how could things kind of keep going the way they are going? Because I think that's always interesting too. I guess I have the same view I had before with the basic income thing, because you talked about it before.
Mm-hmm. Okay. Roman.
Yeah, I find your idea fascinating. I'm wary of what's going to happen in the next year or two. It's a bit worrisome, actually.
In the financial markets.
Mm-hmm.
Steve?
Well, it seems like the shadow banking sector, they get to keep all the profits, but if they start having losses, then they get bailed out.
Right.
Yep. Welcome to modern capitalism.
Glad I'm understanding that.
Yeah.
And even if they were regulated and there was a minimum price, which is sort of just when their assets become troubled assets, then the government will buy the troubled assets. That's some given floor price, which is still sort of, they still can't lose. They can only win.
Yeah.
And then sort of get bailed out.
Yeah.
Yeah.
Yep.
Does that
I'm
qualify under the bullshit? Or is that like a dream
A
job?
term that Alex, they use in economics for this is moral hazard, that you may have heard Alex say a lot. Like you may know that already, but yeah, there's like this moral hazard of being, you know that you're going to be bailed out. So like,
Sure.
yeah.
And that's why some people objected to those bailouts.
Right.
I mean, they
Yeah.
thought they should learn their lesson and not be bailed out.
Right, exactly.
Richard.
Privatize profits and socialize losses. Well, you can do what Iceland did and prosecute the CEOs and things of the bank, and they might learn from that instead of like they did in the U.S. and just do some low-level people and put them in prison.
Interesting. Yeah, that's an alternative. Right.
Mom?
Yeah, thanks, Alex. I learned a lot.
Okay.
Great.
I was thinking before I came in.
And Mitchell.
So Mitchell says, still feel like I have more to learn by going through more of Perry's content. Yes, definitely. It's so much fun. And if you have any questions, let me know. I really liked Roma's hypothetical about how would you kind of keep this going, and kind of going through the thought process of what they would have to do in the event that we don't have a basic income to keep things stable and prevent credit bubble from collapsing, that kind of thing. And I think, the answer is what Steve said. It's, allow the shadow banks to have all the profits and then bail them out. And have,
We should start having these at like Goldman Sachs boardroom or something. They would cater our dinners and stuff.
But
we don't have to be here.
Here in the basement.
But the flip side of that is that the way you avoid that situation is by having a basic income.
Right.
So that's the thing that makes it so that the shadow banks don't get all the profit and then get bailed out. Right. You have a basic income, you can let them fail, and they might not even get as big in the first place because we don't need as much money.
Don't tell Goldman Sachs that, or they'll come out against basic income.
Yeah.
They won't cater our food anymore.
I thought this was a great discussion. Definitely, I thought about this a lot while I was taking the money and banking course, but that was a long time ago. And when I read this book, and that was a long time ago too. But when we had the discussion about Fed accounts a few weeks ago, and we were talking about, okay, even if you eliminate normal banks, most of the lending is in the shadow banking system. I was like, okay, we need to do it on the shadow banking system, and I need to brush up on all this shadow banking stuff.
Yep.
So great discussion, guys. Next week we're going to talk about the mainstream perception, mainstream discourse of basic income, because it's very different from the way we talk about it here.
Right.
So I've got two articles. One of them is by an economist at MIT, Daron Acemoglu, and then another one is by journalist Annie Lowry, who wrote a book about basic income. And they both kind of, one of them is more pro-basic income than the other, and they both kind of talk about basic income from the more mainstream perspective. So we'll talk about that.
Right. Wasn't she the moderator for that panel?
Mm-hmm. She was our moderator. She was
one of the panelists.
Panelist.
Right, you came to that. I forgot. She was the one who Skyped in.
Yeah. Right. Okay.
Okay. All right. Thanks, guys, and thanks, Mitchell.
Thanks, Mitchell.
Thanks, Alex.
Yeah, I learned so much, Alex. Now I understand shadow banking.